Hello, this is a brief tutorial on how to use the internal rate of return function in Microsoft Excel and a quick definition of internal rate of return and some circumstances where IRR might provide some misleading results. So first, what I want to do is look at these set of cash flows. You can think of this as a government savings bond or a savings account where you invest $100,000 and from year 1 to year 3 you get $5,000, and then in year 4 you retrieve your initial investment plus $5,000. So first, let's define internal rate of return. The first part, internal. So what it does is it solely looks at these internal factors. It doesn't take into account interest or discount rates. All it looks for are the cash flows of a closed system or a business unit, and then returns or gives you the rate of return what you get on your initial investment. So if to do this in Microsoft Excel, you want to go to your formula builder, which will be under your toolbar. You can search for the internal rate of return function in the search bar, and it will be under financial. Now, internal rate of return, you highlight all of the cash flows, including year 0. This differs from net present value, where you have to enter the year 0 investment manually. And then it will ask you for a guess, and I will highlight that later, but explain that later. Right now I'll just do 0.1. So we can see the internal rate of return for this savings bond or savings account is 5%. And that makes sense here. You're getting 5% return on your $100,000 every year, and then you return your initial investment. So let's look over here at this new product line where you invest $100,000 and you get these cash flows from year 1 to year 10. Here I have your net present value calculation, and with this I want to highlight why you have to put in your guess without getting too much into the math. I'm going to graph this out, a scatter plot, and you can see how our graph here crosses 0, and then as it's getting less and less returns, it's coming back towards 0. So basically the internal rate of return function, it calculates where these 0 points are to get your internal rate of return. So if these cash flows were to decline quite a bit more, we'd have another 0 over here. And this is why you have to put in an approximation, because there could be 2 answers. So often with fairly standard rates of return, I'll just put in 0.1 because I'm not expecting to get more than 85% return or so. So we'll double click on our internal rate of return function, highlight all cash flows including year 0, and then format this cell so that we can see the contents. And we have a 13% return on our initial cash flow using this series of cash flows. And you can see that the internal rate of return, one rule for internal rate of return is that you will always accept investments that are higher than your opportunity cost of capital. And in this case, we've got our opportunity cost of capital set at 10%. So this would be a good investment. You can see that by the positive net present value as well. Now, here are some circumstances where internal rate of return can return some misleading results. So what I want you to do is, we'll assume our discount rate is 0.1, and look at these two businesses, Paul's Pizza and Sam's Salami, and just for a second, think which business you would prefer to own. Okay, so now we will calculate the internal rate of return. Again, double click, highlight all cash flows, do our guess, and this business has a 25% rate of return. Now compare that to Sam's Salami, highlight cash flows, do our guess. Sam's Salami has returned a rate of 22%. Now, given these two numbers, you might think that it is a better idea to invest in Paul's Pizza. However, you have to understand how internal rate of return works. So what internal rate of return assumes is that you are able to invest these early cash flows or reinvest these early cash flows at 25%. Now, this may not be the case, particularly because of the law of diminishing returns. You could reinvest that $10,000 into more pizza ovens, but at some point you're going to run out of space. You're not going to be able to hire more workers, etc., etc. From an investor's standpoint, if we do the net present value function at a rate of 10%, that's 0.1 there, and our values year 4 to year 1 plus our initial investment, this has a present value of around $8,000, whereas Sam's Salami has a present value of approximately $10,000. So from an investor's standpoint, Sam's Salami adds more value, around $2,000 more value to whatever corporation or your personal investments. So when comparing two mutually exclusive investments, it is important to be aware that internal rate of return will favor early cash flows, and that can be misleading. So in these circumstances, it would be very prudent to add a net present value calculation. Now, I wanted to highlight both net present value and internal rate of return because, as you can see from this data gathered by the Journal of Finance Economics in 2001, net present value and internal rate of return are the two most common investment and valuation techniques used by CFOs. So I appreciate you watching and hope this helped. Thanks.